Catastrophe did not sneak up on America in 1929. It was broadcast in plain sight. The Dow hit record highs. Nearly 40% of stocks were bought on borrowed money. Insiders like Joseph Kennedy quietly cashed out, days or weeks before average families ever sensed a threat. The official story calls it a sudden collapse. The evidence reveals a harvest for the few and ruin for the many. If every red flag before 1929 was waving, why did no one act? The answer begins just before the first elite made their escape. Joseph P. Kennedy's name appeared on brokerage ledgers with a pattern that made no sense to the crowd. In the late summer of 1929, as the Dow Jones climbed past 350, Kennedy's accounts began to show a steady stream of sell orders. Not a panic, not a wholesale dump. A methodical exit. Shares of utilities, rails, and blue-chip industrials liquidated in blocks, with cash quietly swept into safer banks. His letters from the period, preserved in the JFK library, speak of a market swollen by borrowed money and a sense that the orchestra was playing its final song. He wrote to a confidant, "Only a fool holds after the orchestra stops." The evidence is not rumor or legend. Kennedy's brokerage files, reviewed decades later, reveal a timeline. Major positions cut down weeks before the crash, not in the heat of October, but while newspapers still promised endless prosperity. By the first week of October, his exposure to equities had dropped to a fraction of its former size. Remaining funds shifted into cash, short-term bonds, and as later affidavits confirm, a handful of short positions against the most overvalued trusts. Kennedy's actions were not public knowledge at the time. The ticker tape still printed new highs, and the country's optimism drowned out warnings from those who watched the ledgers more closely than the headlines. But in the private rooms of banks and clubs, his absence from the market was noticed. His brokers at Hayden, Stone, and Company processed his orders in a steady rhythm, never flooding the market, always blending into the daily volume. It was not luck or guesswork. Kennedy tracked margin totals, the rise in call loan rates, and the swelling liabilities of investment trusts like Shenandoah and Blue Ridge. He saw the fragility built into the system, how even a modest drop could force liquidation across the board. By the time October 28th arrived, Kennedy's risk was minimal. His capital was already repositioned, his ledgers closed on the summer's highs. For him, the crash was not a disaster, but a confirmation, a harvest reaped from reading signals others ignored. The record is clear. The first to act were not the first to panic. They were the first to see that the story of endless prosperity had already ended, and the real story was unfolding in silence, ledger by ledger, behind closed doors. The summer of 1929 delivered a spectacle. The Dow Jones soared to 381.2, more than 6 times its value from just 8 years earlier. Headlines celebrated new millionaires. Every city had its crop of stock market stories. Clerks, teachers, factory workers, all convinced the boom had only begun. The boundaries between Main Street and Wall Street blurred as ordinary Americans opened brokerage accounts, eager to ride the wave. But the real engine behind this prosperity was borrowed money. Nearly 40% of all stock purchases on the New York Stock Exchange were made on margin. With as little as 10 cents on the dollar, a retail investor could control entire blocks of shares. Brokers extended credit freely, advertising the dream of quick riches. Newspapers ran full-page spreads explaining how to buy on margin. The message was clear. Why wait for savings when you could borrow your future today? Margin debt swelled to over $8 billion, more than the entire United States currency in circulation. Investment trusts, those new financial machines, borrowed even more aggressively, stacking leverage on top of leverage. Each trust owned shares in the next, creating a web of cross-holdings that no one fully understood. Shenandoah and Blue Ridge, two of the largest, offered prospectuses promising double-digit returns, all financed with other people's money. The feedback loop was relentless. As prices rose, more people borrowed to buy in, pushing prices higher still. A 10% drop could wipe out a typical margin account, but few paused to consider the risk. Instead, trading volumes shattered records. The ticker tape ran hours behind, unable to keep up with the frenzy. Brokers' offices overflowed with crowds, their eyes glued to the board, their fortunes hanging on every uptick. September 1929 brought the crescendo. The Dow reached its all-time high. Optimism drowned out caution. Editorials declared a new era of American wealth. In reality, the market's foundation rested on loans and speculation. The smallest tremor could force the sale of millions of shares. The system was primed not for endless growth, but for a shock that would test every borrowed dollar. On July 10, 1929, the Federal Reserve Board raised its discount rate from 5% to 6%. The decision, recorded in the board's own minutes, was not unanimous. Chairman Roy A. Young faced a divided room. Some members argued that tightening credit would rein in speculation. Others warned it would choke the entire system. But the policy went through. Within days, the effects rippled outward. Foreign investors, especially in London and Paris, began moving their money out of New York. Gold reserves at the Bank of England climbed as American exports of gold surged past $100 million between July and September. In August alone, the United States shipped $57 million abroad, a reversal from earlier inflows. Call loan balances held by foreign banks in New York, which had peaked above $850 million in July, dropped by nearly $150 million before the end of September. Each week, cable cell orders multiplied as cash left Wall Street for safer ground. Treasury reports tracked the outflow. Capital that had once fueled the boom now drained away, week after week. The rate hike changed the game for everyone. Brokers found it harder to extend easy credit. Investment trusts that relied on short-term loans faced rising costs. The great tide of foreign capital, which had propped up American stocks for years, began to recede. In the financial press, the shift was barely noticed at first, just a line in the Commercial and Financial Chronicle, a footnote in the Treasury tables. But for those watching the numbers, the message was a leer. The world's bankers were voting with their feet. As the summer drew to a close, liquidity thinned across the system. The Dow still hovered near its peak, but behind the scenes, the fuel that had powered the rally was vanishing. Each tick up in the discount rate, each transfer of gold, each cable cell order was a quiet warning. The market's foundation, once so solid, was beginning to hollow out. The next tremor would not be absorbed by easy money or foreign support. The warning was plain for anyone willing to read the ledgers. Investment trusts, the financial marvels of the late 1920s, operated on a foundation that looked solid only from a distance. Their prospectuses, printed in fine type and optimistic language, promised double-digit returns, but the real engine was leverage. Ratios would make even seasoned bankers uneasy. Balance sheets from the summer of 1929 show Shenandoah Corporation holding $10 in assets for every dollar of shareholder equity. Blue Ridge, its close cousin, sat at a ratio of nearly 8-to-1. Goldman Sachs Trading Corporation, the architect behind both, kept its own leverage just under 6-to-1. But the lines between these entities blurred with each new issue of shares. The structure was a web, not a wall. Shenandoah owned a stake in Blue Ridge. Blue Ridge returned the favor. Both held parcels of Goldman Sachs Trading Corporation, and each trust's assets included shares of the others, sometimes as much as a quarter of another's outstanding stock. A dollar invested in one trust echoed through the system, counted multiple times, inflating both apparent strength and actual risk. This cross-ownership meant that a drop in value anywhere sent shockwaves everywhere. A modest decline in the market could erase the thin layer of equity supporting each trust, forcing them to sell assets, often shares in their sibling trusts, into a falling market. The feedback loop was brutal. As trusts sold to meet margin calls, prices fell further, triggering more calls and more sales. The circular structure, praised in prospectuses for its efficiency, now amplified at every tremor to a landslide. Contemporary coverage in the New York Times tracked the unraveling. Headlines shifted from celebration to confusion as trusts reported sudden losses, and redemption requests. Board minutes, later subpoenaed for congressional hearings, recorded directors' private doubts. Yet the machine rolled on, powered by borrowed money and mutual promises. By October, the system's fragility was no longer hidden. The smallest shock could, and did, set off a chain reaction, turning a correction into a cascade. Jesse Livermore did not wait for headlines or panic. As the summer of 1929 wore on and the market's euphoria peaked, he turned to his ledgers and the tape. Every failed rally, every spike in margin debt, every divergence between bonds and stocks fueled his conviction. Livermore's diary from September traces a pattern of methodical short selling, scaling into positions as the Dow flirted with its highs, then adding again when the market shrugged off early warnings. He did not move all at once. Each new round of insider selling or margin stress was an invitation to increase his bets against the market. His brokerage tickets from late September revealed a scale: short sales in steel, rails, and the most overextended trusts. By October 24th, his exposure was measured in tens of thousands of shares. Livermore watched the investment trusts, Shenandoah, Blue Ridge, and their kin, leveraged to the edge, their balance sheets stretched thin by layer upon layer of borrowed money. He saw what the public could not: a system primed for forced liquidation at the first real shock. On October 28th, as the market convulsed, Livermore doubled down. His diary entry for that day is terse: a list of new short orders and a note about the collapse in trust prices. While others hesitated, he executed. The profits that followed were not the product of luck or rumor, but of relentless attention to the signals buried in trading volumes, margin calls, and the silent retreat of professional money. Livermore's strategy was not to escape the storm, but to stand directly in its path, armed with data and discipline. Bernard Baruch's reputation rested on more than just instinct. His letters held in the Library of Congress describe a market that had grown dangerously detached from reality. Months before the crash, Baruch instructed his brokers at Brown Brothers to reduce exposure across the board: utilities, rails, and industrials, always in increments, never in a way that would call attention. In private correspondence from September 1929, Baruch wrote, "Selling came from institutions and wealthy circles, not the crowd." His words were not speculation, but confirmation. The exits were real, and they were organized. Baruch's brokerage statements from late summer show a steady withdrawal from equities, with proceeds funneled into cash and short-term bonds. He shared his reasoning in a note to a confidant. The market's rise was built on borrowed money, and the network of trusts had become a house of cards. In another exchange, he warned that headlines were misleading, masking a silent retreat by those with the most to lose. By October, Baruch's exposure to stocks was minimal. He had already moved significant assets out of the market, well before the panic. This pattern did not go unnoticed among his peers. In club rooms and private offices, Baruch's actions were discussed as proof that the smart money was no longer betting on endless prosperity. His correspondence became a quiet signal, circulating among those who understood its meaning. The record is unambiguous. The exodus was not rumor, but fact, confirmed in the ledgers and the letters of men like Baruch. The story of October 1929 was already written in these private exchanges, long before the public would see it on the ticker tape. Behind the marble doors of New York's private clubs, the guest lists thickened as October 28th turned to night. Names that rarely appeared together signed in. Bankers, brokers, attorneys, each bringing a rumor or a ledger. Hotel registers in Midtown filled with late arrivals, some checking in under initials, others using staff to send urgent notes across the city. Western Union's ledgers recorded a surge in domestic telegrams, more than double the usual volume for a Monday night. Minutes from club meetings later subpoenaed show gatherings stretching past midnight, with handwritten notes about asset rotations, liquidity, and the safest havens for cash. The city's financial heart pulsed in private, not on the ticker, but in message logs and check-in slips. By dawn, the network had quietly aligned its strategy, ready for whatever the opening bell would bring. Montague Norman at the Bank of England moved quickly as cracks spread across the Atlantic. In the weeks after the Federal Reserve's rate hike, the bank's gold reserves swelled as American shipments pushed London's stockpile above £150 million by September. Each shipment was a vote of no confidence in Wall Street's rally. Telegraph wires between New York and London hummed with sell orders and urgent requests for funds. American banks, short on liquidity, began calling in loans. The withdrawal of foreign capital forced brokers to tighten credit, just as oil and wheat prices slipped to their lowest levels in years. Commodity tables from late September show crude oil down nearly 20% from its spring highs, with wheat prices tumbling alongside. The global retreat was visible in every ledger, reserves rising in London, loans drying up in New York, and commodity markets buckling under the strain. The world's caution became America's weakness, and the flow of gold out of the country signaled that the safety net was vanishing fast. The opening bell on October 29, 1929, triggered a mechanical avalanche. Orders flooded the floor, but buyers were scarce. More than 16 million shares changed hands, twice the previous record. The ticker fell behind by nearly 2 hours, printing prices that no longer existed. Brokers scrambled to process trades as the market's depth vanished. Insurance companies rotated into bonds, seeking safety as equities collapsed. Clearinghouses logged mounting stress, their ledgers filling with failed trades and margin calls. By midday, prices had fallen so fast that sellers outnumbered buyers by 10 to 1. Every thin bid was overwhelmed. Every stop-loss order triggered another wave. The system itself became the engine of collapse, volume feeding on volume, liquidity evaporating with each passing minute. The data from that day, charts fractured by plunges and ticker tape tangled in delay, record not just panic, but the market's own machinery unraveling under the weight of its promises. Today, markets move faster, and leverage runs deeper than ever. Margin debt in U.S. equities topped $900 billion in 2021. The cycle of warning and neglect endures, and the signals still whisper before they scream. In finance, history doesn't simply repeat, it compounds. The next avalanche will not come without warning. The only real surprise is who chooses to listen.